Hi, I'm Brett Hickey, founder and CEO of Star Mountain Capital. Excited to be here for part of Star Mountain Capital's Market Insights Views from the Peak. Today, joining us is Evan Frazier from Marquette Associates. Evan, thank you for joining us. First off, to give the audience a little bit of context, today we'll talk about markets, your views around private credit, secondaries in general, how those can be complementary for an investor's portfolio, and then also to give some tips to the audience on how you look at manager due diligence when they're looking to choose between a lot of managers, how to help them with that. So to give some context, tell us a little bit more about Marquette and the perspectives that you're able to bring to the table.
Yeah, absolutely. So Marquette Associates is an institutional investment consulting firm. We've got about 400 or so billion in assets under advisement across 400 or so clients and cater to a bunch of different client types. So publics, Taft-Hartleys, E&Fs, you name it, we do it.
That's great. Sounds like 400 is a good number.
Exactly right. Nice and round.
That's right. So first off, let's get your views, Evan. We look at the markets today. The public markets continue to push through all-time high after all-time high. There's a big dislocation between how the public equity markets are operating and the fixed income markets. What do you see, and how are you helping guide your clients in a world of, I assume at minimum, uncertainty?
Yeah, so as it relates to our views on the economy, I think we're maybe more sanguine than most. So we think about the Fed's dual mandate, right? Inflation and the labor market. As it relates to inflation, we're seeing price levels obviously coming down, right? CPI is around 2.5%, maybe less than that. Core is a little, stickier, but that's allowed the Fed to, obviously the jumbo cut a few weeks ago, the 50 basis point cut. The market expects future cuts from the Fed, maybe 2 to 3 through the end of this year and then more into 2025. So that's positive. And then as it relates to the labor market, I know there was some concerns, obviously, with the July employment report, maybe some issues there. But since then, the numbers seem to be pretty good. I mean, the September report kind of blew away expectations. You had, I think, 250,000 new jobs added to the U.S. economy in that month alone. So when you take those two things, I think we're pretty positive at a high level. There are certainly concerns, obviously. We have geopolitical issues. We have a couple of hot wars in Eastern Europe and the Middle East. And then you have a bit of, I would say, consumer weakness. So when we look at the consumer, there are subsets of the American consumer that we feel like might be weakening, particularly among, the lower income folks. We're seeing more debt transition to delinquency. We're seeing more kind of, higher debt burdens as a percentage of income. So that's worrisome a little bit. There are always going to be pros and cons, but we think the Fed has been able to navigate this tricky situation pretty well.
That's great. That's helpful. So as you think about what I'll call air pockets in the economy, whether it's different markets, different parts of the markets that might be overheated, and the economy is not all one, right? You've got certain areas of the economy that are really hot, really efficient, really competitive, a lot of capital inflows, and basic laws of supply demand, right? You've got a lot of money chasing the same thing. That tends to push risk up and returns down. And there's other ends of the market that are really challenged and don't have such enormous capital inflows. That might have better supply demand characteristics. So as you think, Evan, about the markets today, where do you find areas that might be good diversifiers for clients that are less hot and therefore some perhaps better risk reward opportunity for them, at a minimum portfolio diversification?
Absolutely. Well, before I answer that question, I do want to address the idea that certain areas of the market are running hot. I agree with you. I mean, I started my career sort of covering public equities. I think Goldman came out with a report yesterday or 2 days ago that said that they expect nominal returns for, I think, just broad U.S. equities to be 3%. Annualized over the next decade. That's a staggeringly low figure, and it kind of makes sense, right? I mean, we've seen massive run-ups within public equity markets over the last, really since the GFC, right? So over the last 15 or so years. And so, while we certainly think our clients need exposure there, because frankly, people have been saying that equity returns are going to be low for a while, and that's kind of yet to materialize, right? Last year, this year, things have been good. But that does kind of make us focus more so on, other kind of niche areas of the market, private credit being one of them, of course. I think the nice thing about private credit, in our view, is the idea that we can sort of ride through certain economic environments in a more stable way. I think a lot of the private credit strategies we use are able to be a little bit more resilient through various economic environments and provide that kind of downside protection in ways that traditional kind of, whether it's public equity or even, we saw in 2022, right, public fixed income markets didn't hold up relatively well either. So I think that's certainly an area of interest for us.
That's really helpful. Let's switch gears now as we see the U.S. economy and investing. Far less than 10% of the companies are publicly traded.
Yeah.
So the vast majority of the opportunity set are in the private markets. And it's kind of interesting that it's called alternatives.
Yeah.
Normally in life, if you say, well, 90% is this, it would be the 10% piece that's more of the alternative.
Yeah.
But because the world used to have more publicly traded companies than there are today, and many of these private businesses that were founder, owner, operated, were not available to be invested in because they're owned by founders and families that are today, with aging demographics, now open to taking third-party capital, open to selling their businesses. So as you guys now help clients evaluate and look at the private market world, what are some tips you can provide on evaluating managers to find the right people to assist in originating, underwriting, and managing assets in the private markets?
Yeah, well, so I could talk forever about this. There are so many things that we look for in managers. I'll just give you a couple. Number one, vehicle availability, I think, is really important to us. We've been talking a lot more about sort of evergreen structures in recent time. I'm sure you're hearing a lot about this as well, right? We work with, maybe on the institutional side, a little bit smaller to mid-size institutions that maybe aren't able to access, certain investment strategies in traditional ways. So we're looking for, open-ended evergreen structures, whether it's within private equity, private credit. So the extent to which managers can have those offerings, I think that's very, very helpful. And then other things we look for in managers, we just look for good partners, right? So we want alignment of interests. We want, when you guys do well, we do well, and vice versa. Fees are always important, so managers that are willing to, come to the table on fees for us is helpful. And also we were talking about this before we started rolling, sort of intellectual humility, honesty. People are willing to come to the table and say, hey, you know what, we maybe made a mistake here. Here's how it happened. Here's how we're working to remedy this issue. Folks that are willing to be proactive rather than reactive in terms of, providing us with information, data. We ask for a lot of data. Anyone who's watching this, who has worked with us in the past, knows that we ask for a lot of data on our portal, so I apologize for that. But it really is important because we do a lot of manager comparisons. We put these things in front of our clients. They're very, very important to us when it comes to evaluating managers. So folks that have the resources and the capabilities to provide us with that type of information, that type of data, those levels of kind of proactivity rather than reactivity, that's super helpful for us.
Evan, let's look at, we've had what I'll refer to as the longest expansionary period in history, leading up to the COVID market downturn, which was really almost a synthetic downturn because there was so much government stimulus that supported it, and I think a lot of banks and others were very patient with people because of the humanitarian challenge. And so if you lead into that, we had 128 months, I believe, of economic expansion in the U.S., which was the longest in history, 8 months longer, I believe, than what we had, or it was 158 months, and then I think prior to that, 120 months leading into the 2001 market collapse, the longest. If you then take out that little COVID dip, we have another 28 months.
Yeah.
So in totality, the total number of months, and I'm directionally accurate here, is really long. So as you think about people investing today and folks that have never invested through a downturn, never managed challenges, and you overlay that with what I think of as risk retention, or as you say, alignment of interest, everybody's good at doing well.
Yeah, sure.
The question is when there's challenges, and a market downturn will likely come at some point here, whether it's a hard, soft landing and so forth, time will tell, but challenges are near inevitable.
Yeah.
And we have a cohort of people that may not have economic alignment of interest, skin in the game, and perhaps have never worked through challenges. How do you guys think through that in this dynamic today that's new for many people.
Yeah, well, it's so interesting you say that, and I'll admit it. I mean, I've only been in the industry for 7 years, so I've never really lived. I mean, other than COVID, I haven't lived through a GFC, right? And there are a lot of people like me, my age, whether it's on your side of the aisle, my side of the aisle, right? Relatively inexperienced through these hard times. And what I would say to that is, well, first of all, you're right. It's easy to manage through good times, whether you're an asset manager, whether you're a consultant. Maybe we have some clients who are saying, well, why do we need to hire you guys, right? Let's just go passive and make a ton of money. And that's good when it's good, and then when things turn around, maybe less good. So I think for us, we look for teams that are, obviously well experienced, folks that have lived through downturns, have been able to manage through a downturn, to the extent that a track record is available that dates back, pre-GFC, maybe even pre-internet bubble. We can see kind of how teams have managed through those periods of difficulty, how opportunistic they are, right? Because, as you well know, when, markets draw down, there are dislocations, that creates opportunities. So while we want managers to be, defensive and resilient through those periods, we also want them to view those periods as buying opportunities, right? As opportunities to deploy capital into turmoil, because those can sometimes be the opportunities most rife with potential. So really, it's about finding those teams that are well experienced, well versed in terms of navigating those difficulties. Those are the folks we like to partner with.
That's awesome. Great insights and perspective, and we'll see what happens ahead of us. But I think you'll have a chance to work through a downturn sooner than later, would be my guess.
I hope not, but you're probably right.
Awesome, Evan. Thanks a lot.
Thank you, Brett. Appreciate it.